Today, we're going to dig into the world's biggest operational hydrogen power plant, RWE's dramatic exit from a $10 billion Namibian export megaproject, and Western Australia's integrated hydrogen steel strategy. If you want to know what's working in hydrogen, what's still broken, and how tech leadership, market economics, and policy align, or don't, this is the episode for you. All of this on today's Hydrogen Podcast. Let's begin with Xinjiang, China, home to Sinopec's Kuqa green hydrogen pilot, a 300 megawatt photovoltaic megaproject set to supply more than 20,000 tons of hydrogen annually to local refineries. The scale here is unprecedented. $470 million invested, 618 million kilowatt hours per year of renewable energy, and hydrogen pipeline infrastructure capable of moving 28,000 cubic meters per hour. Operationally, this project uses direct coupling. Solar panels send electrons straight to electrolyzers, minimizing curtailment losses and maximizing conversion efficiency. Wind is also integrated on the grid side, pushing total hydrogen output even further. What does that mean for economics? With a levelized cost of hydrogen in key Chinese provinces between $2.80 and $5.90 per kilogram, Xinjiang's mega plant lands right at the competitive edge. That means green hydrogen deployed here is not a climate luxury. It supplies process industries like refining ammonia and methanol at prices that rival imported natural gas. In technical terms, the plant's electrolysis stack run at over 55% efficiency, featuring robust operational lifetimes above 40,000 hours. The spherical storage tank design provides daily load following, smoothing power fluctuations while making delivery to end users seamless. On the economic and social impact side, Sinopec projects $20 million per year uplift in local GDP, $2.8 million per year in regional tax revenue, and over 400 long-term technical jobs, plus tens of thousands of construction jobs during ramp-up. The carbon abatement? Close to 480,000 tons of CO2 per year, not including associated reductions in local air pollution, with the plant feeding clean hydrogen directly to replace natural gas in major local refineries. Looking ahead, China's national roadmap targets 100 gigawatts of installed electrolyzer capacity by 2030, making the Kuqa facility a technical milestone and a bellwether for future scaling. The region's low water stress and DC-coupled renewables are critical. Other regions looking to replace this will need high renewable capacity factors, favorable grid interconnection, and supportive permitting, plus customers ready to anchor offtake. Next up, the setback. Germany's RWE walked away from the $10 billion Hyphen green hydrogen ammonia project in Namibia, leaving a gap in Africa's ambitions as a future hydrogen export powerhouse. Initially, this project promised 300,000 tons per year of green ammonia to European and regional buyers starting in 2027, leveraging massive wind and solar resources. So then, why did RWE pull the plug? Well, first, it's demand. European buyers have yet to sign binding volume contracts at price points that work for long-term financial investment. Non-binding MOUs don't fund billion-dollar ports and electrolyzers. At current delivered costs, often $4 to $6 per kilogram for hydrogen, $900 to $1,200 per ton for green ammonia, even generous subsidies fail to drive enough actual European buying. Second, technical and infrastructure risk. Namibia faces the dual hurdles of desalination costs, grid build-out, and port upgrades, all required for reliable export at gigawatt scale. Upfront capex is high, over 80% of project costs front-loaded, and OPEX uncertainties related to local supply chains, water, maintenance, and fuel logistics added further risk. Notably, RWE stated their exit was about commercial demand, not political or indigenous land concerns, though local opposition continues. Third, broader market signals matter. RWE refocused on power generation, fortifying its $32 billion asset base in Germany, UK, Turkey, and the US. With European ammonia and hydrogen buyers slow to ink contracts and regulatory frameworks changing, RWE found better risk-adjusted returns elsewhere, a lesson all global megaprojects must heed. Existing projects in Spain and the Middle East are facing similar delays, with financiers demanding tight links between supply, policy, and offtake. Only local projects with ensured payback, flexible technology design, and off-grid industrial demand will weather these cycles. The message: scale alone does not guarantee market. Pivoting to Western Australia, the state government and industrial partners are betting big on hydrogen-based green steel as Asia's solution to decarbonize. Western Australia mines about 800 million tons per year of iron ore and is building a new ecosystem of direct reduced iron or DRI plants, green hydrogen electrolyzers, and green steel recycling mills. 3 signature projects are underway. A $400 million rebar recycling mill in Collie using renewables-powered electric arc furnaces, and a $2.5 billion DRI plant set to transition from natural gas to green hydrogen as supply ramps up. These facilities integrate global tech from Daniele and local supply chains and are primed for flexible operation, balancing grid, solar, and wind to optimize cost and emissions. The economics are compelling. Techno-economic analysis pegged green steel production in the Pilbara and Eyre Peninsula at $720 to $850 per ton for EAF DRI blends, dropping below $700 as hydrogen falls towards $2 per kilogram. That's competitive with traditional blast furnace steel, especially as carbon prices in export markets grow. EU allowance permits near €90 per ton, with border adjustments likely. Pilbara's wind and solar hybridization and salt cavern storage minimize operating costs and solar intermittency, a model for every region aiming to leverage its own natural resources. Australia's government is investing around 500 million Australian dollars into regional hydrogen hubs and onshoring, multiplying the job creation, value addition, and export diversification. Environmental wins are equally large. Switching to hydrogen cuts CO2 by 70 to 85% for steelmaking, while slashing NOx and PM2.5 in mining and port towns, where air health is a decades-long issue. Flexible operations allow green steel mills to provide frequency services and grid balancing to the wholesale market, boosting system reliability. With Asia's growing appetite for decarbonized iron, Australia's play isn't just hydrogen for climate, it's a strategic, competitive climate policy driving regional value for decades. What ties these stories together is the reality that hydrogen's expansion at scale is only as strong as the economic and market fundamentals. China's power plant shows what happens when cost, local demand, and policy move together. Rapid scaling, jobs, and emissions cuts. Namibia's case proves that even with world-class resources, large-scale projects require hard offtake agreements and infrastructure. Without that, even $10 billion investments can vanish. Australia's green steel momentum reveals how hydrogen's market can pivot. Rather than trying to export bulk hydrogen using embodied hydrogen to create decarbonized goods that are easier and cheaper to ship, and for which market premiums already exist. Analysis from Monash University and Australia's Geoscience underscores this approach. Shifting value upstream, regional clustering, and operating flexibility can unlock new export avenues and stabilize grid costs long term. Globally, industry watchers estimate that the hydrogen market will hit $556 billion by 2034, growing at 7.8% compound annual growth rate. But the energy independence hype is gone. The sector's future is in smart tech trade-offs, policy support that align with commercial reality, and leveraging hydrogen's air quality wins, lower NOx, SOx, and PM2.5 as public health and ESG imperatives. Clusters, offtake anchors, and industrial integration, not just standalone export terminals, are driving the transition. The future for hydrogen is neither blind optimism nor pessimistic retreat. It's a climate-competitive market built project by project with economics, technology, policy, and health at the core. Whether you look to China, Africa, or Australia, know that the world's leaders in hydrogen are learning fast, focusing on what works, and dropping what doesn't. All right, that's it for me, everyone. If you have a second, I would really appreciate it if you could leave a good review on whatever platform it is that you listen to. Apple Podcasts, Spotify, Google, YouTube, whatever it is. That would be a tremendous help to the show. And as always, if you ever have any feedback, you're welcome to email me directly at info@thehydrogenpodcast.com. So until next time, keep your eyes up and honor one another.